So friends, welcome to this session of solar project financing. In this session, we will first explain about the key terms in financing, and then we'll explain this financial model. I have opened a financial model, as you can see my screen. And before we explain you the key terms, I thought let me give you a project background. So the project background is that, let us consider first screen is implementing a 1 megawatt project in Rajasthan, and it participated in a tendering process. Nowadays, the 1 megawatt projects are not available. These are 5 or 10 megawatt. But for the sake of simplicity and understanding, we have kept the capacity to 1 megawatt. In this financial model, you can change it. It will be easy to relate few numbers on per megawatt basis. So I have describe this to you on 1 megawatt basis. Now, if you look at this financial model, first let me explain few terms. So capacity of a project is defined as the installed capacity. It is defined as a DC capacity as well as a AC capacity. In DC capacity, whatever is the DC capacity of solar panels you are having, and the AC capacity is the inverter capacity you have. So those are the parameters which are defining this. Here we are not getting into the DC AC ratio or the technical terms, but consider this is a 1 megawatt DC capacity we have. So on a per megawatt cost, we have considered 400 lakh or 4 crore per megawatt. This is a typical prevailing market price for a solar project. Okay. And per megawatt basis, you should have a thumb rule that it is producing about 15 lakh units in a year. And the tariff which is available currently is, let us keep it to 5 rupees per unit as tariff. So I have explained you the project capacity, the tariff and capital cost. Now, let us discuss about the financing structure of this project. So, financing structure is explained here. Here, you will find the debt equity ratio. So, how much is your project's debt component and how much is your equity component? So, the loan component or debt component in this case is 70% and the equity component is 30%. So, essentially, you have 280 lakh rupees as your debt component, and equity requirement for this project is 120 lakh rupees. The depreciable assets are 400 lakh. This is to keep simple, but in solar project, you know, the land is also part of the project cost, and land cost cannot be depreciated as per the income tax rules. So we have kept it for the simplicity that all the project cost is depreciable. Okay, and these are the taxation issues. So what you have is the corporate tax. So any corporate in India pays about 33% of the tax, and solar projects are having some taxation advantages in initial 10 years tax benefits, but you have to pay MAT. This is known as minimum alternative tax. So MAT is about 20.01. Even if you do not have a tax liability, this much is the minimum tax you have to pay in your project. Now, let us discuss few more parameters. We should also discuss that there is a PPA, Power Purchase Agreement terms we discussed. Power purchase is the agreement which is signed by the project developer. In this case, project developer is First Green. It is signing the PPA with or DISCOM. So PPA is signed at 5 rupees and there is no escalation considered in this case. The other benefits in the projects can be available. For example, if you have the REC benefit, then that is the additional benefit you get in your project. Here, in the first case, we are not considering the additional benefit, but if it is a captive or a group captive project, then you can get additional benefit. So if you consider like 1 rupees per, you can have carbon credits also as other benefit in this project. So right now I am not considering. We will see the alternative scenarios. At that time, we will consider the alternative benefits. So we have discussed couple of parameters. So first thing is that we have to understand how much is the project income. So we have considered that the 15 lakh units are produced every year, and these units, if you see over the years, these units are reducing, and this reduction is about 1% per year. We have given the reduction in power generation every year by 1%. Typically, the PV module has a degradation rate about 0.7%, but for the sake of simplicity, we have kept it as 1%. So every year you can see the generation is reducing, and this is what being reflected. And your power tariff is this. So 15 multiplied by 5, you get 75 lakh rupees is your net revenue from the project. So this section is known as project income section or cash inflow in the project. Now let us discuss the outflow. In the outflow section, you have the O&M expenses, you have insurance, and you have interest payment. So these are the total expenses. Total expenses is the summation of O&M expenses, insurance, and interest payment. Now, typically the O&M cost is considered here. We have considered that O&M cost is about 3% of your capital cost. So you have some 12 lakh rupees per megawatt per year as the O&M cost. Then this is a typical insurance rate, and you have the interest payment. Now, interest plays a very important role because out of this 40 lakh rupees as the cash outflow, the major outflow is 27 lakh rupees, which is contributing to about 70% of the cash outflow. As you see, over the years, as you keep paying the debt, your interest payment comes down, and you see in 7 or 8 years, or over the 10 years loan period, you have paid your interest fully. And here, why it is happening in 10 years is because we have defined that my interest on term loan is 10%, the repayment period is 10 years, and moratorium period, that means how much time will I take to make first installment. So that is half a year, because initially I will not have that much capital available. So we start paying after half year. That is known as moratorium period. Generally, it is 0.5 year to 1 year. And you are to pay typically all the payments through 38 installments. You will have installment 40 years, but because there was a moratorium period, that is 0.5, so you are getting 38 installment, and that too, these are known as quarterly installment. And the solar projects are subjected to accelerated depreciation, and this depreciation rate is 40% per year. We will explain the depreciation in some subsequent things, but these are the terms which are required for understanding the commercial transactions. So once you have these cash inflow we have understood, we have also understood the cash outflow, and this is the installment of the loan you are making. So what you can do is you have the cash flow, and on this basis you are calculating the equity IRR and the project IRR. When you consider the project IRR, you also consider the cash outflow for repayments as well as interest component. In the equity IRR, you are only considering the cash inflow and cash outflow related to the project expenses only. You do not consider the cash outflow related to the interest payment. So in this case, what you get is you get the equity IRR as 24.35 and the project IRR as 16.56. We'll share this, but if you look at clearly, there is a formula of equity IRR and project IRR associated in each cell. You can refer this for making this. Now, it is important to understand whether this IRR is reasonable or not. So if your interest rate is 10% and the project is giving you a return of 24% as equity IRR or 16% as project IRR, that means you are good to go for this project. But if your tariff comes down, like if you're participating in reverse bid and you reduce your tariff, let us say if you are reducing the tariff by 4 rupees, the equity IRR will come down to 6%, 6.86%, and project IRR is 10. Then in this type of situation, the project is not viable, or the returns are not so attractive because the equity IRR is less than the interest rate. Even project IRR is also at par what is your interest. So you are not earning much about it. Then it is not a bankable project. There are many other factors how you should evaluate and what are the factors you can consider to do this. But if the project cost is 400 lakh and if your tariff is this much and if your generation is this much, then this is what you get, and it is not a good sign for the project. So you have to revisit your decision if you are participating in a reverse bid. Friends, we will discuss some other aspects also in my subsequent session. We will also discuss about a detailed cash flow and how this depreciation calculation is done and the taxation issues in my next session. Thank you very much for this session.